Fed Jerome Powell did it, ladies and gentlemen. That is why we have been talking about a potential Fed bounce. He came in right on expectations, and we're going to get into exactly what he said because there were some bearish things that he said, but much more positive things. So, getting straight into this video, Fed Jerome Powell, let's start with the bullish. Fed Jerome Powell raised rates by 50 basis points, not 75 basis points. That was seen as bullish. That was the market's expectations. On top of that, the Fed basically said at the next two meetings, they are not even thinking about raising rates by 0.75%, or that 75 basis point rate hike that they are considering two back-to-back 0.5% rate hikes, 50 basis point rate hikes. So that was seen as a bullish thing. Why? Because the markets were pricing in with about 30 to 40% probability of getting a 75 basis point rate hike. On top of that, Jerome Powell did essentially say that they are going to start reducing their balance sheet June 1st, but it's going to be very gradual, that it's not going to be the $75 billion pace to start off. And you guys can see right here that that is what they plan to reduce the balance sheet by. But starting in September, everyone was expecting the $75 billion per month to start in June. And that's not what we got. We actually only got about half that amount that starts in June, about $40 billion per month. This is likely because how much the markets have priced in so fast. The markets went from pricing in 3 quarter-point rate hikes in 2022 to 4 back-to-back 0.5% rate hikes. Even if that happens, the Fed is kind of shedding some kind of doubt if that is going to happen. He would not even confirm a 50 basis point rate hike, but that's what a lot of people are assuming. You're going to get that 50 basis point rate hike. So that was seen as very, very bullish, especially this balance sheet reduction situation. It's really kicking the can down the road in a quite dramatic way. I really did not expect this, but this is definitely a great thing. And a brief lesson on why that is so big for the markets is, one, because the markets do not know how to react to the balance sheet being reduced. The balance sheet has only been reduced by about $800 billion during this point in history from 2018 to early 2019, and the stock market fell dramatically during that same period. If you go ahead and pull up 2018, 2019, this whole year was not a good moment for the stock market. So that's what we have to really go off of. So if we're going to delay this, then it must be a bullish thing. And those were the single two most bullish things. On top of that, the Fed really pushed back on the odds of a recession, saying specifically that recessions typically are followed after unemployment rates increase. He's saying it's the opposite of that. Unemployment rates are dropping, that we're not heading into a recession. He did acknowledge the 1.4% negative GDP print that we've seen in Q1, basically chalking it up to the very volatile readings of excess inventory as well as net exports, saying that China being shut down really does kind of hamper some of, potential inflation residing, saying that that will likely be a drag on the next couple of CPI reports. But that's why they're looking at core CPI much more than your regular CPI number that the markets like to latch onto. Core CPI is CPI minus food and energy. The Fed basically acknowledged what we already know, that the Fed cannot control the supply side issues, but they can hamper on demand. So what you got from the Fed was a very confident Fed, for one, but you also got a lot of reassurance that a recession is not likely here in 2022, pushing back on that quite dramatically, not reducing the balance sheet as aggressive to start off, and not raising rates as aggressive as the market started to price in. So that is a recipe to see a 3% positive day in the S&P, to see an over 3% day in the NASDAQ. Russell 2000 up almost 3%, and the Dow Jones up almost 3% as well. Now, as far as the bearish side, like I said, there was some bearish comments that the Fed did make. Obviously, the biggest one that really sent the markets into this period of extreme volatility after the report was the mention of China and how that could slow our economic growth, how that could be a big issue to inflation. That's what caused the markets to hit 414 at the lowest point and then rally literally $15 from the bottom after the conference started. So all in all, very, very bullish. Could have been a whole lot worse, but the balance sheet and basically ruling out 50 basis point rate hikes at the next two meetings are the biggest bullish things. And I think that is going to carry us through a rally here in the S&P and a lot of the stocks that have been beaten into the ground thus far in 2022. Now, that's why you could see SoFi stock was up 11.5% today. It was a very positive day for SoFi stock. And why is that? Well, because the Fed and fintech, they go hand in hand, especially if SoFi has already been beaten down so much on the anticipation of potentially seeing a 75 basis point rate hike, seeing those possibly back to back or even a 1% rate hike. The fact that the Fed kind of, relaxed the markets on that kind of super bearish sentiment about raising rates over and over and over again, these extreme amounts, is bullish for SoFi. That's why I say Fed and fintech go hand in hand. And that's exactly what we've seen today for SoFi stock, now sitting at $7.14 per share, minus the 3-cent move here in after hours to the downside. You're sitting at about $7.11 per share, which is a much needed bounce. Now, in my personal opinion, it's not over. You're probably still going to see a continued rally over the next couple of days. Like you seen back here during the last Fed meeting, it was bullish for a very long time. Like the next 10 days were pretty much all green besides this one day in here where you actually did drop 1.31%. So I don't think it'll be as aggressive as this, but I am targeting the range of about 438 on the S&P, and that should bring SoFi up quite dramatically, even come back up to the 50-day moving average, currently sitting at $8.62 per share, or even as high as $10 per share. Now, I don't think you're going to get a runaway SoFi stock here. I don't expect SoFi to go back to, $14, $15 per share, because the Fed is ultimately still raising rates at a very aggressive pace, and they're trying to destroy demand. But you got a little bit of a cool off to that extreme market sentiment. So it can definitely fuel a potential rally to the upside, and that is certainly what it looks like. We'll see what happens when futures actually do come out, how it looks like we will open tomorrow. But a 3% positive move after the Fed is really reminiscent of what we seen last time around. But like I said, actual pricing and charting for SoFi, watch $8.62 per share. For the downside, watch $5 per share. If for whatever reason the markets digest this as negative, that's the level that I would watch. I think it's very unlikely at the current moment. Now, keep in mind, on the RSI, we are still oversold under the neutral rate of 50, and you're sitting at 45.82. So definitely some more potential steam to the upside we could get here over the next couple of days. The MACD just went bullish after being bearish ever since April 7th. So almost a month straight, the MACD has been firmly in bearish territory. Now is looking bullish. Definitely a good thing. Now let's go ahead and look at SoFi stock short interest and the option activity for the day. And we can see that the short interest is sitting at 19.56%, which that will also help the markets to go up in a dramatic way. Not only SoFi, but a lot of stocks that have a high short interest, or just the S&P 500 in general. Now, why is that? I'm sure you guys know about a gamma squeeze. When people start to buy options, it basically makes the market makers have to go out and buy shares to hedge for those options and eventually sell you their shares that they bought to oblige for those call options. That is essentially a gamma squeeze. Now, a reverse gamma squeeze works the same way to the downside. When you have a 2-to-1 put to call ratio like we had heading into the Fed meeting, basically meaning that for every one call you had 2 puts coming through on the option chain, it really forces the market makers to short stock to oblige for those put options. When the markets start to reverse, and especially after a 3% day, then you can see the market makers really start to de-hedge those puts and start to actually buy back their short positions on the open markets, thus meaning stocks can rally pretty hard. And that's what happened during the last Fed meeting, and I think that is what is likely to happen here after this Fed meeting. So that is, in summary, why SoFi stock as well as the broad markets might continue to trend upwards, especially throughout the rest of this week. Next week is going to be a wild card. I would watch for any China developments as well as potentially the war in Ukraine. If there's any like nukes used, that's going to obviously be a very bad thing, and the markets are not going to like that. But overall, definitely a very positive reaction so far. Now, let's get back to SoFi stock. I just wanted to tell you guys that because it's very important. Options work very well to the upside, but they also work very well to the downside. When you see a rapid recalibration and the markets go up this dramatically, this fast, you see a lot of de-hedging on the put side, which does mean the markets tend to go up after that. Now, like I said, the short interest of free float, 19.56%. Current shares that are sold short of 142.36 million. Cost of borrow max of 2.73%. Utilization of 100% and days to cover sitting at almost 4. So if we do get that continued bullish momentum in the markets, then it is very likely to continue to see SoFi stock well outperforming the markets, right? SoFi was up 11% even with this move down, and after hours still up 10.94%. So you're probably going to see that outperforming of SoFi comparatively to the broad markets for the next couple of days, in my opinion. Now, for the option flow sentiment, you're looking at 5 orders totaling $317.59 thousand. Positive order value of 12%. Over the past week, 36 orders totaling $10.76 million. Positive order value of 85%. So essentially what you've been seeing on the option chain is a lot of short-term put activity and a lot of long-term call activity. We've went over this many times, but it's basically saying a lot of short-term downside pressure, a lot of short-term shorting via puts, and then a lot of long-term net positive exposure, assuming all these 2023, 2024 call options that are on the option chain. So all in all, I'm very bullish about what we're seeing in the markets. Obviously, it's hard to be bearish right now, and specifically with SoFi, I think it's going to be a great thing. So that is going to be all for this video. That is what you guys need to know. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. What do you guys think about this rally, about the situation? How high do you think we can go? Or do you think we're just going to give it all back up and go straight back down? Now, my personal opinion, it looks like you have a gap to fill up to about 438 on the S&P, and that would not surprise me to see a move here in the next coming days close to that range. That's about 2% from where we are currently at, and that could be even reasonable tomorrow, given that's what happened the day after the last Fed meeting, was a rally of about 2.22%. So that is going to be it. Thank you guys for tuning in. Enjoy the rest of your day, and I will see you in the next one.